Every central banker promises markets are stable, every finance minister swears the system is sound, and every single time they're concealing the most dangerous leverage trap in modern history. The yen carry trade, Japan's free money machine, a $20 trillion house of cards that's quietly funded every major asset bubble of the past 3 decades. Rome believed their currency was eternal. Britain thought the pound would rule forever. America convinced itself 2008 could never happen again. All of them ignored the warning signs hidden in currency markets. All of them dismissed the leverage building beneath the surface. And right now, the same pattern is accelerating toward a breaking point that makes 2008 look like a warm-up. But here's what makes this different. This time, the leverage isn't trapped in housing or bank balance sheets. It's woven into the entire global financial system through a mechanism most investors don't even know exists. When it snaps, every asset class moves simultaneously. Stocks crash, bonds whipsaw, currencies spike, and the dominoes fall faster than central banks can intervene. The question isn't whether you believe this could happen. The question is whether you'll recognize the tremors before the earthquake hits. Because when 20 trillion yen in borrowed yen needs to be repaid, it doesn't just shake Japan, it crushes everything. The story begins in Tokyo, 1990s. Japan's economy had imploded, growth flatlined, deflation took hold. The Bank of Japan's response? Cut interest rates to zero and keep them there for decades. By 1998, Japanese banks were practically giving money away. Borrow yen at 0.25% interest, convert to dollars, invest in U.S. bonds yielding 5%, pocket the difference. This wasn't genius, it was arbitrage on steroids. Hedge funds discovered it first, then global banks, then pension funds, corporations, even Japanese housewives nicknamed Mrs. Watanabe got in on the action. Borrow cheap yen, buy anything yielding more abroad. Real estate, emerging market bonds, tech stocks, commodities. The scale? Staggering. By the mid-2000s, trillions in yen-funded capital was sloshing through global markets. It inflated asset prices everywhere from Manhattan condos to Brazilian equities. The carry trade didn't just fund speculation. It became the invisible engine of globalization itself. But here's the catch. The entire system rests on one assumption: the yen stays weak. Because if the yen strengthens, those borrowed funds suddenly cost more to repay. A lot more. Think about it. You borrow 1 billion yen when it's worth $7 million. You invest abroad, make profits. Then suddenly the yen surges. That same 1 billion yen now costs $9 million to pay back. Your gains wiped out. Your position underwater. This is the nightmare scenario baked into every yen carry trade, and we've seen it explode before. 1998. Russian debt crisis hits. Panic spread. Investors rush to close positions. The yen surges 15% in days. Hedge fund long-term capital management collapses. The Fed orchestrates a bailout to prevent global meltdown. 1999 Lehman Brothers fails. Risk evaporates overnight. The yen spikes 30% in months as traders scramble to repay loans. Emerging market currencies crash. Stock markets collapse worldwide. The carry trade unwind deepens the crisis. Now here's where it gets controversial. Some say the yen carry trade is just one factor among many in financial crises. Others insist it's the hidden detonator that amplifies every crash. I lean toward the latter because the numbers don't lie. When yen funding costs spike, every leveraged position globally comes under pressure simultaneously. But I want to hear from you. Drop a comment. Our carry trade unwinds the real cause of market crashes or just a symptom? The data could support either. Let's debate. Yet after every crisis, something strange happened. The carry trade came back stronger. Japan kept rates at zero. Global investors returned to the same game. Borrow yen, invest everywhere else, rinse, repeat. By 2018, analysts estimated over $20 trillion in global financial flows were linked to yen funding. That's the entire GDP of the United States. The carry trade wasn't just a market strategy anymore. It was a pillar of global finance. When the yen weakened, risk assets rallied. When the yen strengthened, markets tumbled. One currency pair, USD/JPY, became the invisible lever controlling worldwide sentiment. Even Bitcoin felt the influence. Crypto liquidity dries up when carry trades unwind. But here's where the danger multiplies. The trade depends entirely on Japan never raising rates meaningfully. For 30 years, that held true until now. 2023. Inflation returns to Japan for the first time in 40 years. Energy costs soar, food prices climb, wages rise. Suddenly, the Bank of Japan faces an impossible choice. Keep rates near zero and watch the yen collapse further, or raise rates and risk detonating the $20 trillion carry trade. The BOJ tried threading the needle through yield curve control, capping bond yields by buying unlimited bonds. But as inflation persisted, investors began betting the policy couldn't last. Meanwhile, the Federal Reserve started cutting rates in 2024. The gap between Japanese and U.S. yields narrowed. The fuel feeding the carry trade began evaporating. If you've seen this pattern play out in your own investments, sudden liquidity vanishing, volatility spiking for no clear reason, drop a comment. Your experience matters. I'm tracking how widespread these tremors really are. Here's what happens when the unwind accelerates. First, short-term yen borrowing costs rise. Leveraged traders get squeezed. Then Japanese bond yields climb as the BOJ stops printing money to suppress them. Finally, as investors anticipate tighter policy, the yen strengthens fast that triggers a global scramble. Hedge funds dump assets to raise cash. Emerging market currencies crash as capital flees. Corporate bond spreads widen. Stock markets tumble. Even Treasury yields whipsaw as institutions liquidate anything they can. This isn't theory. The Bank for International Settlements, the central bank of central banks, warned explicitly that Japan's ultra-low rates created the world's largest source of hidden leverage. Translation: when Japan sneezes, global markets catch pneumonia. The scary part? Most exposure is invisible, buried in derivatives, swaps, complex financial products regulators don't fully understand. When the unwind starts, liquidity vanishes instantly. Currencies spike, interest rates whipsaw, and leverage unwinds in a violent chain reaction. Picture the dynamic. Yen strengthens. Traders panic. They sell assets to repay yen loans. That drives the yen higher, which forces more unwinding, which pushes the yen even higher. It's a feedback loop that only stops when central banks intervene massively. And we're already seeing the early stages. The yen has strengthened from 30-year lows. Japanese bond yields hit multi-year highs. Smart money is unwinding positions preemptively. Here's my prediction. A major yen carry trade unwind will trigger a 20% plus correction in global risk assets by late 2025. I could be wrong. History has surprised us before. Comment below if you think I'm right, if you think it'll take longer, if you think it won't happen. Let's see where the community stands. When the unwind hits full force, the first casualties will be emerging markets. Brazil, Turkey, South Africa, all heavily reliant on foreign capital, will see massive outflows. Their currencies will sink. Borrowing costs will explode. Then Western markets follow. European banks face liquidity crunches. U.S. tech stocks dependent on cheap money crater. Bond yields spike temporarily before crashing as recession fears take hold. The 2008 playbook repeats. But this time, central banks have far less ammunition. Their balance sheets are already bloated. Interest rates were already cut. Quantitative easing already deployed. What's left? Coordinated intervention, currency swap lines, emergency liquidity, a modern version of the Plaza Accord where major economies attempt to stabilize exchange rates jointly. But there's a twist: geopolitics. The yen carry trade has long reinforced dollar dominance. Most borrowed yen gets converted to dollars to buy dollar assets. When that reverses, dollar demand actually falls. China and Russia, already building alternatives to the dollar system, could seize the moment. More trade in yuan, gold-backed settlements, a multipolar monetary world emerging from the ashes of the carry trade era. For individual investors, this isn't abstract macro theory. It's a survival warning. If you own assets inflated by cheap liquidity tech stocks, real estate, high-yield bonds, you're exposed. When liquidity tightens, valuations compress. It's not about whether an asset is good or bad. It's about whether there's enough money in the system to sustain its price. Some are already preparing, rotating into hard assets, gold, commodities, cash-flowing businesses that don't rely on constant refinancing. But here's the uncomfortable truth. There's no escaping the global impact. When $20 trillion unwinds, even safe havens get shaken. The coming unwind will test everything: market stability, central bank coordination, the illusion that finance can be fine-tuned like a machine. Because the carry trade isn't innovation, it's a bet on complacency. It assumes low rates, stable currencies, and abundant liquidity persist forever. But every monetary regime built on excessive leverage eventually cracks. The last 40 years were defined by cheap money, debt expansion, and monetary engineering. The next 40 might be defined by the slow, painful reversal of all three. And in that transition, the yen, the quietest currency in global finance, might roar the loudest. So when you see headlines about the yen strengthening or Japanese yields rising, don't dismiss them as local news. They're the first tremors of an earthquake that could reset the entire global system. And if history holds, those who understand this invisible mechanism will not only survive the shakeout, but thrive in what follows. I've covered the mechanics, the risks, and the timeline. But I might have missed something. What warning sign am I not seeing? What historical parallel did I overlook? Experts and skeptics both welcome in the comments. Let's crowdsource the full picture, because when $20 trillion unwinds, the world doesn't end. It reshapes. New winners emerge. Old powers fade. The only question is, which side of the divide you'll be on when it happens. If this analysis opened your eyes to the invisible forces shaping global markets, hit subscribe, because history has all the answers and we're going to need them. Check the description for full sources, data analysis, and strategies to position yourself before the unwind accelerates.